we're going to now bring on board Adrian Mowat, Chief Emerging Market and Asian Equity Strategist at JPMorgan. Adrian, hi. Good to have you on the show as always. Asian markets have been, jittery of late due to the China issue. Do you see more weakness, A? And can the Crimea situation also unnerve investors? If so, to what degree?
Yeah, I think these are two very important factors that are making investors nervous. So in Crimea, we've got the potential escalation of sanctions, the de facto annexation of Crimea by Russia, and some strong domestic political reasons why Putin would want to continue that. So I think investors will be worried about that, particularly maybe the impact on European trade if sanctions do escalate. The friction or concern around China is primarily to do with economic data, which remains soft. I would particularly note some of the declines in transaction volumes we're seeing in the property market. The other important factor to look at is the currency, which has weakened. I mean, the weakening is modest in terms of percentage change, but it's very important in the change of direction. And we are concerned that that may cause speculative positions to be unwound that are short dollars, long renminbi, and that could have an impact on domestic liquidity in the Chinese financial system.
Adrian, morning. Nikunj also joining in. Another key event that markets are looking for is the FOMC meeting. What are you expecting from Yellen's first FOMC presser as the Fed chairman?
I don't think that Russia will dominate the Fed's comments. What investors are going to focus on is whether she reaffirms the idea that short rates, so the Fed fund target rate remains low. It's currently 1/8 of a basis point until inflation is above 2% for 3 months. So I think it's going to be the relative focus on inflation hitting a certain level rather than necessarily a focus on the unemployment rate, which had been Fed guidance under Bernanke.
For the moment, it's all about momentum and blue sky territory for Indian markets. What do you make of the rally in Indian stocks? Is a favorable outcome from elections already priced in?
I think there are two drivers to this rally. The first is more comfort on funding the current account deficit. So we've had data that's confirmed a contraction in the current account deficit. We're seeing good capital inflows into India, and that's been expressed in a rally in the Indian rupee. So I think that's been an important factor in driving this market higher. But I'd also agree that the political change or prospective political change is helping investor sentiment. And the way to measure that, in my opinion, is to look at the rotation into domestic cyclicals, which is beginning to happen in India.
Adrian, so, markets are reading of elections usually off-center. Do you see a possibility of disappointment, and should investors take positions accordingly then?
Look, I think if the market come May is discounting fully a change in the government, then there is a risk that you get disappointed. It's important to understand that 70% of the vote bank is in rural areas. It is difficult to judge how they will vote, particularly when you've had schemes such as job creation schemes in rural India, as well as increases in the intervention price for key grains. So it may be possible that the perception of the current government is more favorable in rural India than it is in urban India.
Adrian, so how healthy do you think this rally has been? Because foreigners have invested close to $1 billion. On the other hand, domestic institutional investors have been rampant sellers.
Well, this is just a mathematical reality. If foreigners are net buyers, domestics have to be net sellers. What I've found with my local client base is the pace of redemptions that they've been suffering from for the last couple of years is moderating. So I think there's a good chance that you have demand for equities both from foreign and local investors with limited supply, and that should lead to higher share prices.
Adrian, so, I mean, doesn't higher exposure to foreign funds put Indian markets at risk if there is an unfavorable geopolitical event or a fractured political mandate or an earnings slowdown as well?
Well, I think the question sort of answers itself. If perception of risk rises, then people will sell equities regardless of whether they are locally domiciled or foreign investors.
Adrian, you have been overweight India. Now, does the recent rally make it a bit expensive? Would you rather pick some other country? Or do you think that Indian fundamentals are looking strong and you should be a buyer rather than a seller?
For now, we're very happy to maintain our overweight in India. You highlighted earlier the situation with the election, and I think the market will continue to price in a change in government, and that'll be positive for the market. The currency looks very comfortable, and with problems in Crimea making Russia unattractive and Turkey and arguably CE3, plus concerns about Chinese economic growth, then I think India remains a very interesting exposure for emerging market investors.
So do you see a strong rebound in the rupee close to 6